Hey, I'm James Cook with Yale Realty and Capital Advisors. Founded the firm back in 2012. Been selling manufactured housing in RV parks since 2007. Actually, I took my first listing on one of these communities, a hybrid community, in 2005. So, been in the industry just under 20 years. And today we are a national firm that sells and finances roughly 90 to 100 manufactured home communities and RV parks annually. We've seen trends where more of that business has been manufactured housing for many, many years, but there are years where RV became a larger percentage of our business. And there's been years where I think probably 40% of our business was RV parks on the brokerage side, at least. That trend has pulled back a little bit in recent years, post COVID. Today, I've got on the line here with me, Joe, you want to introduce yourself?
Yeah, hi guys. My name's Joe Bono. I'm the market research analyst here over at Yale Realty. We're gonna get into a white paper that we recently published and go over the data as far as revenue, expenses, what we've seen as kind of national and even regional trends. And I'm excited to jump in.
Yeah, thanks for coming on, Joe. Joe's been a huge asset. So Yale underwrites billions of dollars annually of manufactured home communities and RV parks. We put out a white paper on the manufactured housing industry maybe 90 days ago, or a few, 3 to 4 months ago. And just recently, we announced our white paper on the RV industry, which I was really excited because I don't know of anything else of its type out there nationally. So I want Joe to share a little bit about the high level on what amount of data he processed, and some of it we'll talk about some of the trends that he observed looking at this data. And then we'll get into a market update generally on valuations of RV parks and what we're seeing. So Joe, give me a high level. How many parks, how many sites, tell me a little bit about the
hmm
size of this data pool that you queried to put together this
hmm
white paper.
Of course, James. Yeah, to kind of give you a reference point of how much data we actually put into the model to undergo kind of these national averages. We have just over 28,000 sites, 185 communities nationally. The data spans from 2021 to 2024, so we have about 4 years of data. To give you kind of a background into how the data is compiled, we used a weighted average. In that case, the data is spread across all 4 years, is averaged out, and we can, eventually get into the numbers where we broke down not only revenue but expenses by categories. Big categories include insurance, payroll, utilities, maintenance, general and administrative, and taxes, as well as taking a look at the OPEX ratios.
It's great. Yeah, appreciate that. So we saw this trend generally in the country where people rushed RVs during COVID. So that 21,
Mhm.
22 period were known to be some of the strongest years ever for RVs. In fact, I have an article on my wall. It was an Wall Street Journal. I think the real estate section of their newspaper came out and said it was, I forget which year, 21 or 22 was the year of the RV. So we saw this huge spike in interest from the consumer standpoint. And then, of course, the investors piled onto that trend and started building a lot of parks. So we've seen kind of ebbs and flows of demand, and we've also seen a lot of inflation across the country. So Joe, I guess give me an idea. First off, what did you see for revenue growth the last 4 years, and then maybe we could segment it by size of property as well.
Yeah. So getting into rental income, we broke out not only rental income, but ancillary income. Over the last 4 years, we were seeing kind of with inflation about 3.5 to 4.5% compounded annual growth rate. We saw a little bit of a fall off or almost stagflation in 23 to 24. But overall, you can expect nationally, we've seen RV parks go from roughly 3.5 to 4% as far as revenue. On the expense side of things, one that particularly stands out would be insurance. Insurance has been a huge kind of player when looking at underwriting. Insurance grew 19% compounded annually. I believe it's close to 63% for parks over 200 sites in the last year, and 28% in the last year for parks under 100 sites. So, especially not only over the course of 4 years, but especially in the last year, we've seen insurance definitely play a big part as far as a percentage point in terms of growth. Payroll has grown, utilities have grown, taxes have grown. Closer more to 6% for payroll, utilities are around 7, 7.75. taxes at 20%. A lot goes into taxes as far as reassessment and those sort of things. Um, but yeah, insurance is definitely the biggest part. Another thing that I think is important to the listener is the operating expense ratio. We saw in 2021 the ratio around 47.72% for all parks across the country, and that's grown to about 53.62 in the year 2024. So about a 590 basis point jump.
Yeah, I think that's interesting because when we are spitballing with an owner and they'll tell us their park's grossing $1 million, the standard number that I've used pretty much my whole career is if it's a typical RV park that's a little more operationally intensive, it's about a 50% expense ratio. Whereas in the manufactured housing industry, we've always used the rule of thumb of 40%, knowing that if it's a super stable, high occupancy, high resident owned community with low amenity exposure, those can be as low as like 30 or 35%, depending on variables like real estate taxes, and other kind of regional expenses. But on the RV side, we have seen it go from just under 50% to a little over 50%, 47% up to 53% on an OPEX ratio. Joe, one thing I noticed was you have this economies of scale based on the larger the property, the better efficiency you have on expenses. But I think that it needs to be explained that that probably doesn't directly apply to utilities or specifically electricity. It feels like the electricity expense savings is really directly correlated to the reduction in revenue. When you look at the larger parks, they do less revenue per space. So I think it's proportional, the electric revenue reduction per space, and as the parks get larger, and the actual revenue per space as the parks get larger. But if you want to walk us through for a few seconds, kind of the overall, savings that you
Mhm.
saw in the data from larger properties versus smaller properties on an economies of scale basis.
Yeah. So I just want to simply start off by talking about utilities. I think that's definitely a very unique expense. Specifically with utilities, we happen to also categorize it as a whole of all different types of utilities collectively, but also breaking it out. We saw that electric, water, sewer, and trash account for about 75% of all utility costs. In regards to electric, things can definitely get tricky. As you mentioned, larger parks had lower revenue, and we saw the same as far as costs for electric was also lower for larger parks. Another point to make is that electricity largely is involved with how transient or long term a park is. Typically, what I've seen across the country, across the board, would be that any stays over a month, usually a community is metering the electricity. So that's something to definitely take into account. As far as economies of scale go, like you said, we're definitely seeing it even in the OPEX ratio. OPEX is about 48.96% for 200 plus site parks versus parks under 100 sites. It's about 51.54. The bigger numbers, as far as a per site basis, the big drivers of expenses are payroll, insurance, and utilities. Payroll we saw was about $1,100 for parks under 100 units versus 200 plus site parks was about 839 per site. And with parks between that 100 and 200, about $1,000. Similarly, insurance expenses for larger parks, they paid about 30% less. Utilities followed suit with large parks, about 35.5% lower versus the smallest segment. And to kind of just bring it all together, you're certainly seeing across the board payroll, insurance, utilities, that the larger the park, the larger the cost is spread out on a per site basis. And that's been true throughout this paper. I think it's one of the main points, main drivers of RV is that the larger you go, typically you're going to see your per site costs in all major all may be reduced.
Got it. Got it. Yeah, well, I think it's worth pointing out that typically larger communities are going to basically achieve a lower cap rate. They're going to typically increase the number of institutional players that are willing to bid on them. So, in general, you're looking at a higher margin and you're looking at a lower cap rate. So, a much better multiple on the sale of a larger park north of 200 spaces. Not to say there aren't plenty of buyers out there that like to buy well located 100 space properties or 100 to 200 space properties, but the highest margin and the lowest cap rate are going to be applied to that 200 plus space park. And I think that's because the market recognizes that economies of scale are definitely real, and it just is an overall preference to buy larger revenue streams. So, I think I'll let that be a transition to kind of the demand for RV parks from an investment standpoint. Our main businesses are obviously financing properties, raising equity through joint ventures for properties, and then selling them. And I think most of our audience is going to be curious, hey, what's my property worth today? I might have bought it 10 years ago, and I'm wondering, where we're at today, or maybe I bought it during the during the pandemic, and I might have paid top dollar. Am I okay? Am I upside down? And what I generally say is we've seen a major drop off in RV sales, RV park sales. Um, I think, we saw kind of a peak in 22 for sales of RV parks. 23 was still a good year. 24 was a very, very slow year, and it kind of followed the trend of revenue flatlining. Our sample set shows that revenue was up slightly in 24. We're hearing a greater sample set nationally. Revenue might have actually fallen for 24. So I think a lot of times folks that are underwriting properties or considering sale are more likely are selling a property that's doing well. They're not going to come to us necessarily to sell when their revenues are down. So we're going to have a biased set of data on the revenue side. But nonetheless, 24 was a very slow year for RV park transactions. I think we did somewhere under 15% of all of our transactions were RV parks, where typically it's more like 30 to 40. The same trend is proving true in 25. I think we've just sold a handful of RV parks this year. Despite having a good year overall, we've seen volume up about 30% in our firm, but RV parks have only been a small percentage of that, maybe 5 or 6 assets total nationwide, whereas that should be 15 or 20 on the brokerage side, for instance. And I think that's what you'll find across the board. We followed a lot of our competitors, and we've seen a lot of other deals that we've given opinion of value. We maybe came in a little lower than our competitors, and they never performed. Many of those listings are still on the market or were actually canceled, pulled off the market. So there's a trend now where I believe we're in a great time to buy RV parks. I believe there's a great buying opportunity and there's discounts, and at the same time, I don't know exactly when the consumer trend is going to turn around. So it's just a great time to drive a strong deal when you're in the market. If you've got capital to place, I think you get a higher cap rate today. Leverage is finally getting a little more reasonable. We're back down to seeing rates, kind of in the 6 to 7 range, whereas those rates are 8 to 9, you know, 36 months ago. So rates are starting to come in. We're also seeing cap rates kind of firmly at an 8% cap rate or higher. Some of them are trading at 10s and 11s if they're true, dirt road campgrounds, and some of the trophies and really strong locations may still be trading in the 6s if there's a real story to it. The exception to all that is if you are running a park that functions like a mobile home park that has a high percentage of park models, that's going to be treated almost like a manufactured home community, and the cap rates are going to automatically be hundreds of basis points lower, probably in the 5 to 6 range in great, I would say southeastern or southern markets, Arizona, Florida, and then maybe in the kind of 7 to 8 range, even in the kind of Rust Belt or Northeast, Midwest, Northeast markets. So I think that's a great investment decision to go into a highly permanent RV park. But I think any RV park today is at a great discount, and the industry will come back. Another suggestion I'd have for owners, and we're seeing this trend, especially as I traveled around Texas on a couple of road trips recently, is you can start proactively bringing in park models and making your typical RV park function more like a mobile home park, creating more scarcity for your rolling stock spaces and creating a lower cap rate when you do go to exit, because that revenue becomes more and more predictable and consistent. So those are just a couple of thoughts. I think it's a great time to be a buyer of RV parks. We do have some for sale right now. We are seeing some move. If you would like us to give you an opinion of value, I think it's a great time to reach out. We'll let you know what it's worth today, but we're not going to reach and overpromise, because we don't want to be, looking at your listing a year later and having to ask you to do major price reductions. We want to take listings that we're going to be able to move in our normal, course of business. We normally do a 5-week call for offers, collect 10 to 15 bids, and then we can provide you with a wide sample set of data, a wide range of offers, and you can make a good decision on, hey, this is really what my property's worth based on 50 or 60 or 70 groups looking at it. If we price too high, it'll sit stagnant. We'll get a reduced number of offers, and everybody ultimately loses. So please reach out if we can help you with a broker opinion of value. please reach out if we can help you provide with more data on this market research paper we just did, the white paper. Joe, were there any other salient points on the white paper that you thought we should have covered or that I did miss?
Yeah, so I think there's a couple things, especially this data may be whether it's a seasoned vet or a first time person looking to get into the space. There is a couple points that I think that could be made when comparing different types of RV parks. For example, we took a look at RV parks that are considered long term, so any park that was deemed over 70% of its occupancy as long term versus parks that had over 70% occupancy is transient. And we kind of categorize these two. And we noticed about a 5 point percentage point difference in the OPEX, whereas long term dominant parks average about a 47.6% average OPEX versus transient parks that were transient dominant parks operated at close to a 52.7% OPEX. I definitely think that that's something to consider when you're looking at a park is to kind of get an understanding of, is this park transient? Are they focused on daily, weekly, seasonal versus, maybe it's more of a long term. We see, all the time in Texas, oil workers, nurses, different types of people that are coming in and staying where the park would, typically operate more as sort of like a mobile home park, so to speak. And even accounting for the revenue just by site type, transient sites were about $6,100 revenue per site on average versus long term was about 4,700. We also broke down long term into annual and seasonal. Annual about 5,600, seasonal about 3,800. 1,700 glamping sites is something very new. They Clamping sites and cabins were closer to 14 to 15,000, and that's more that resort style you can expect with that. You know, typically higher OPEX margins with staff turnover and maintenance and such things. But yeah, I think it's important to look at all this information as a whole rather than just focus on one thing. I know we talked about insurance being kind of the biggest expense mover, but looking at all sorts of things, I think taking into account revenue, expenses, where your market, what market you're in specifically, all these different things are going to play a role in how we value, and also how buyers and sellers are going to look at the market.
Oh, that's great. Yeah, it's interesting. The seasonal versus annual business. We have a lot of regions of the country, which I think are great to invest in, the Northeast, the Midwest, around these kind of large cities, that 2 hour radius of a big city, or even sometimes up to three. If you're on a destination like a lake or some major draw, we see a lot of times where those parks are solid booked all season, but they're only open for 6 months. Up where you're at, or Joe, where you're from, upstate New York, you can hardly run an RV park in the winter. Maybe there's a couple spaces that are winterized and somebody still lives there or lives in a nice park model year round. But generally, those parks are pretty much shut down. So there's seasonal parks. It sounded like $3,800 a year for those seasonal spaces. And then for the annual spaces, it was more like 5,700 annualized.
Hmm. Yep,
Yep.
correct.
That kind of fits. That makes sense. In Florida or Texas or Arizona, you could literally live in this park year round. Might get a little warm in Arizona, might get a little warm in Florida. I'm sure parts of Texas, but it's a livable, it's an affordable housing play. So I think that's one other differentiation to think about with RV parks is you have affordable housing and you have workforce housing, and then you also have truly retirement housing. So the affordable housing and workforce housing, is basically your workers that need a place to stay. Maybe they're coming for 6 months, 9 months, or maybe even 2 years, but they want to be able to kind of live in their same castle and move that castle around. That's one kind of a more stable, housing play. And then you have the true, you have the 55 plus, snowbird or senior markets. And then you have true vacation properties, true resort housing, which is going to be higher revenue, higher amenities, and higher touch, which is going to require higher expenses altogether. And that's where the glamping and the cabins fall into that kind of true resort housing. Typically, the Pigeon Forge markets, if you will, or any of the national parks. Those are markets where you're going to have more of that transient business. But Joe, appreciate your time, man. I know we're kind of pushing up against our time limits today, so appreciate you taking the time to give us a recap of this paper. Excited to go through it more myself. And I think that our owners will be very benefited by reviewing it. And a lot of the firms that are looking to get in the space, lenders, private investment, or private equity funds, et cetera, will find a lot of value in that report you did. So thanks so much, Joe.